Crude oil, often referred to as black gold, is a cornerstone of the global economy. This black gold keeps our cars running, fuels our industries, and plays a major role in the global economy, making it one of the most valuable commodities in the world. At the heart of the crude oil market are two key benchmarks: WTI, short for West Texas Intermediate, and Brent. Crude oil comes in various types, each with its own unique properties. These properties include density, sulfur content, and viscosity, which determines the quality and usability of the oil. Generally, crude oil is categorized as either light or heavy, and sweet or sour based on these properties. Now, let's focus on WTI and Brent, the most widely recognized benchmarks in the crude oil market. WTI, as the name suggests, is primarily extracted from regions in the United States, notably Texas and North Dakota. On the other hand, Brent crude is sourced from the North Sea, located between the United Kingdom and Norway. While both WTI and Brent are classified as light and sweet crude oils, there are slight differences in their composition. WTI typically has a slightly higher API, short for American Petroleum Institute gravity, and lower sulfur content compared to Brent. These differences in compositions have significant implications for pricing and market dynamics. WTI serves as the benchmark for oil pricing within the United States, while Brent has emerged as the global benchmark used for pricing in Europe, Africa, and parts of Asia. It's worth noting that both Brent and WTI pricing is influenced by factors such as OPEC decisions, geopolitical events in oil-producing regions, supply and demand dynamics, currency fluctuations, and global economic performance. Both Brent and WTI crude oil futures contracts are actively traded on major commodity exchanges. When venturing into the world of oil trading within financial markets, you won't need to physically buy and sell barrels of oil yourself. Instead, you'll be speculating on the price movements through various financial instruments. There are three main ways to trade WTI and Brent. First is through futures contracts. These contracts represent agreements to buy or sell a specified quantity of crude oil at a predetermined price on a future date. You can either profit or lose based on accurately forecasting the price movement between the time you buy the contract and its expiry. The second way you can trade WTI and Brent is through CFDs. CFDs, or contracts for difference, allow you to speculate on the price movement between WTI or Brent without physically owning the crude oil. With CFDs, you can trade both rising and falling markets, speculating on the upwards or downwards movements of crude oil prices by going long or going short. Lastly, you can trade WTI and Brent through exchange-traded notes, ETNs. These are exchange-traded securities that track a basket of assets, including oil futures contracts. By investing in an exchange-traded note that tracks WTI or Brent, you can gain exposure to the price movements of these benchmarks without the need to directly engage in trading futures contracts or CFDs. When trading Brent versus WTI, it's essential to consider factors such as supply and demand dynamics, geopolitical events, and macroeconomic indicators that can influence the price of crude oil. Additionally, traders can use technical analysis tools and chart patterns to identify potential trading opportunities and manage risk effectively. Diversify your investment portfolio by trading oil CFDs with Vantage today. Oil trading carries risks. It is essential to conduct thorough research before making any investment decisions.